Hello and welcome to a brand new show of Market Makers. Let's take our conversation this time on Market Makers on discussing financials, earnings, elections, and what are the niche ideas in the market right now. My guest today is Sandeep Tandon, and I've interacted with Sandeep for almost 15 years now. We would interact when Sandeep was on the sell side, which is that he would give ideas to brokerages. He would give ideas to AMCs. Now he's running one of the fastest growing AMCs in India. The numbers, if I tell you, when he started from where they are right now, is absolutely staggering in terms of size and in terms of performance. So nice to have you back. Thank you for joining us.
Yeah, thanks.
With a very recent start, you managed to go to 45,000 crore.
We are nearly 52,000 crores.
52,000 crore. That's the last count I actually got.
Yeah.
So it's been a fabulous run for you.
Yeah.
Is this performance or this is differentiated strategy?
So obviously it is performance which is led by differentiated strategy. Okay. See, Nikunj, AUM is good number we have, but what is very important is that we have emerged as a wealth manager for the masses. We have 54 lakhs folio, which is a very large folio. So if you look at last 2 years, we have been one of the top 5 AUM gatherer. But what is more important in terms of folio, we are top 5 in folio also. And that is clearly reflection of retail support which we got from the masses, and that is number is very meaningful. And obviously you have extra responsibility for people that they have showcased trust in you. So I think that's the way one should look at.
Okay, then let's talk about the market setup. And what is your understanding of the market? Risk reward ratio, valuations versus earnings, where do you stand?
So let's look at all three analytics which we look at. Valuations, a lot of people start looking at, yes, it is, I will say is rich, not expensive. Okay. The problem with the industry is that when we start looking valuation in isolation, people start comparing what happened, let's say in 2000, what happened in 2007, 8, or what happened in December 2017 or Jan 2018, few benchmark, okay, or what happened, let's say in September 2021 also, okay. Yes, valuation was rich. Okay. Now, if you look at just one dimension approach, looking at valuation purely from one analytics, then yes, you can conclude that it is expensive. But you start bringing the other dimension to look at what was the risk appetite, what was the liquidity analytics globally. Okay. If I look at 2007-8 crisis, global liquidity is 2 times of that number. Okay. Where markets have to factor that. Risk appetite is is increasing. If you really look at today, India risk appetite is still moved up. Even last month it has rallied further. So when you look at the combination, I don't think there is a euphoria. Okay, so we remain very constructive for Indian equities. I think we have been talking about for last many years that India is in a very unique situation. Both Indian macro, if I look at from an absolute basis and relative basis, we are in a very unique situation. So India remain buy on dip strategy. But if you ask me whether the way small cap has rallied or mid has rallied, so can we say that easy phase of bull run is over? Answer is yes. Okay, but very important to understand, we are still in bull run. We are in difficult phase of bull run, but we are in bull run. Like if you ask me how 2012 onwards, when rally started post Lehman crisis from August 2012, the easy phase peaked out by August 2015, but till 2018 it lasted. So next 3 years was the difficult phase of, we were still in bull run. So I think we are in similar situation where easy phase of bull run has peaked out in India. But from a longer term perspective, I think we are still in bull run. Sector rotation, stock rotation is a strategy to go forward. You have to keep on identifying new sector, new stocks, rather than just believing that I have got a gold mine and I'd like to ride it for next 10 years.
When you say difficult part of the bull market has started, what do you mean by that?
When I say difficult means it's not going to be easy to make money, okay, the way you have made money in last few years, okay, because liquidity point of view, retail flow continues to remain very, very bullish. And I have said this is the best era for retail investor. This actually decade belongs to them. I always talk about this thesis that every bull market has a leadership. Okay, if you recollect, 2000 bull market started in June 2003. It was led by FIs. They made tons of money in India. Okay, and the second phase of bull run started. The second bull market started somewhere in August 2012. Okay, or March 2009. If you look at that, bull run was led by the HNIs, family office. They made a good amount of money. Okay, but if you look at the current bull run, which started in April 2020, when the COVID hit us, okay, that's the time best of the HNIs, best of the family office, best of the institution has given up. They were all worried, okay. But retail had actually made money. They were early in that cycle. Their M2M is very, very meaningful. And hence I'm saying this time they are on the driving seat. And we manage retail money. Their market has become mature, and retail investors also become very mature. A lot of people used to make fun of retail investor. Ki retail participation come at the peak of the cycle, which has changed. I have seen whenever market corrected sharply, flows goes up. Yesterday we got 2 times of the average flow because market corrected. That's the way how retail has become more mature. They have understood the importance of they can multiply their money in the mutual fund industry or on the markets in general. I think the approach has changed, and that's a very sizable number. Say HNIs and family office are limited. Yeah. When you're talking about masses, okay, and we can feel it. So the whole perspective has changed. So what we are talking about from a different perspective, yes, liquidity remain in your favor. So liquidity, like look at the SIP number which is rising. I expect this year will be extraordinary year even from the FIs flow. People will chase India. Okay, people move to China. They have burned their fingers. I think they are coming back to India. So FI flows, FPI, FDI and local flow, all three will remain very strong. So with that background, market cannot correct substantially. Today we have seen last 2 days correction because market has rallied. So if market corrects 7, 8 or 10 trading session, I think this is nothing is actually quite very healthy. So liquidity, great. Now look at the risk appetite, which is a reflection of sentiments data, which is the pure macro data. For macro data are very conservative. So if you look at the holistic picture, then we get a better answer that we are still in a, yes, when I say easy force, because valuations are, it's not that attractive from now. You can't say just say I buy anything and next 3 years because of liquidity I will ride. Maybe you have to rotate, you have to switch on continuous basis. You have to evaluate. That's the way we brought, Nikunj, to be candid with you, a concept of dynamic style of money management versus traditional style. Okay, which has churn a lot on mathematical data. It's an analytic form. So churning is, a lot of people have taught churning, it means you have no strategy, you don't have a thesis. Churning is very important because if environment is changing, look at so dynamic environment we are in, okay? Something happened today morning, something will happen maybe day after tomorrow, who knows what will coming. So if you don't adapt these changes, and based on the risk of environment, if you don't rebalance your portfolio, then it's very difficult to generate alpha. And why one should not do that?
Yeah, I mean, as long as, and I keep on making this point that, look, the cycles are getting shorter now.
Yes.
What used to happen in 10 years is happening in 10 months. What happened in 10 months is happening in 10 days. What used to happen in 10 days is happening in 10 minutes now.
Yeah.
Because of the connectivity, technology, and the whole awareness of information. Okay, your big call was to sell banks. When I say sell banks, you only have 5-7% exposure to financials. Now that looked like a crazy call when you took it, right? The world was saying banks will come back. Nobody wants to miss the benchmark because ultimately mutual funds are mapped to benchmark. But you took a conscious call of keeping your exposure to financials, including banks, so only 5%. Yeah. How did you arrive at that call?
Okay. So let me give you a bigger thesis first. We are writing our new book, which is about to release. We are talking about in next 30 years, the relevance of leverage economy as a concept will decline. The concept of real economy will come back. So banks are the biggest beneficiary of this thesis of leverage economy, okay? And US, why we are so bearish on US in long term, is this thesis, okay? A lot of data points are changing. The concept itself is changing, okay? And then you look at some of more data points we look at, like in 2023, I talked about this year belongs to the most neglected zone, okay, most hated zone category. The admire category stock will not perform. So as a thesis, we spotted that opportunity. That's the reason all public sector banks have done very well as compared to private sector bank. PSU in general has done very well. Metals, nobody used to want to talk about metals, have done well. Okay, media has done well. Mining has done very well. Okay, we were very early in spotting in the beginning of the year in 2023 about pharma. They were in neglected phase. So when any sector or stocks are from a behavior analysis perspective are in trading in the most admired territory, and banks were in admired territory. If you really look at the banking cycle, it peaked out in January 2008. They were all in admired territory. They corrected sharply. But from September 2021, they started coming back from neglected zone. They again reach the most admired territory. Okay, and one of the reason we thought, okay, this is a data point. At least it was very difficult to make money. And one of the reason, if you look at ICICI Bank, we exited our core position maybe 1.5 years back. I think August 2022 we sold.
You sold HDFC Bank also completely.
Yeah, we sold HDFC Bank in September
2020. You only own RBL now.
So we have a thesis for smaller banks or close to book value will do very well. So RBL Bank or Karnataka Bank, J&K Bank. This is a disclosure is there in our portfolio, so I can talk about it because it's already disclosed. Okay. So we have some of these names.
You like smaller banks which are trading in and around the book value.
Yeah. or below book value. When you bought, they were all below book.
So let's split the market the way you look at it, the admired category and the so-called neglected category.
Yeah.
What is in the admired category right now, according to you, apart from financials?
So I think I will not get into any specific sector. Is not looking like, obviously bank was one of the private sector bank. Let's put me private sector bank, private sector NBFCs are still in the most admired territory. Some of the consumption names are still in admired territory, not all. Okay, though we are very turning constructive on the consumption as a cycle, they are still in admired territory. Anything which is in admired territory are also by default are also over-owned stocks. Okay, so over ownership is also their byproduct. Okay, over ownership is a byproduct of admired territory. So if you look at where is the fresh inflow will come from, okay, people already like look at banking sector. Most of the fund have 35 to 40% exposure in banking. Okay. Now, if you ask me from a risk perspective, I have a very different perspective. Okay. Nifty is a very skewed index. Okay. From a mathematical or statistical perspective, it's not a great index. Okay. You can't have all outperformers in and underperformers are removed out. That's not where the globally indices are. It is unfortunate part. It is there. Okay. Now everybody follow those benchmarks. Okay. And in by default, you land up in buying 35-40% banking. Now, as an active money manager, we believe that we don't have any mandate to mimic or hug the indices. So we don't follow any, we don't mimic any index. So hence we are able to take these calls. So it's very important from a purely from talking about risk management. How can you have one single exposure of 40%? We don't, as our fund, when you look at our philosophy of risk management, we don't take any exposure of any sector more than 20% or any group or any company. Company can't be 10%. But even as a group, we don't want to go beyond 20%. Even the best of the company, let's say Tata Group.
Okay. What is in this so-called neglected category which you think you would like to go overweight on and you've been increasing your exposure?
So I think if I have to look at the bigger sectors, I think pharma is still in the neglected. Okay, it was in the most hated zone in February, March of 2023. They have improved a lot, but still neglected. So I think pharma has a sector. For if I look at for next 5 years, let's say minimum 3 years, I think that's the one cycle which is in our favor, which is very meaningful sector for the market and the index itself. So that's the one sector I'm very constructive. Metal also has a very sizable bets, metal and mining both. Okay, that's another area, irrespective of China, irrespective of dollar. I think India consumption is going very well. So that's another area which we like. So we are, if you look at as a fund house, we are grossly overweight. I'm using the word grossly overweight on metals and mining. I think mining will be a surprise element. We have seen a small trailer of 2023 about minings. I think globally, we believe mining should do very well. Okay, that's the reason, particularly lithium related stuff. Okay, that's the reason we are equally positive on the Australian market also. Semiconductor in a big way. I think these are the thesis will come back. So mining, metals mining. I still like media as a thesis, okay? But media sector is very small, okay? So you can't have very sizable bet. We do own some like 2-3% of the portfolio is also in the media space. PSU is another theme which I think has more legs.
More legs?
Yes,
isn't
still
PSU
has.
like the most?
Yeah, it has moved up. So like if I look at from 2021 onwards, they were in neglected zone, hated zone. Now they have, but they have yet to reach that admired territory. Okay, so it has potential.
Even after the recent run-up in defense and railways?
Yes, they have not reached those euphoric
Your
phases.
top 4 holdings actually are, apart from Reliance, you have SAIL, you have Hutco, you have Nalco, you have GAIL. You are buying PSUs.
Yeah, we have been. It's not now. We have been very bullish for last 3 years on PSU. Okay. Even January 2023, if you recollect, a lot of people remember that we have exposure in Adani groups. Okay, Adani group exposure was 6%. But what hurt us in that period, the casualty happened in the PSU. We were 25 to 28% exposure in PSU. But if somebody do a postmortem analysis now, we were ahead of the curve. So we have very large exposure for quite well.
You've sold your Adani exposure completely?
No, we still have. We sold. See, we manage money very dynamically. When it is all about taking a call when unknown risk also. So you have to manage a known and unknown risk both well. So if any unknown risk hit, we do take conscious call. But we do have some exposure. Like if you look at our portfolio, we have very large exposure on Adani Power. That's the one stock we have very large exposure.
Why do you like power?
So power is a larger thesis. I think every fundamental analyst has given in a thesis. We like energy as a thesis. Okay, if you really look at our portfolio, the biggest overweight is energy, which include power also, which include OMC companies also, which include oil and gas companies, okay, even the crude companies. So whether you talk about these names, could be the very size, it could be what, 20-30% exposure will be there. If you look at the collective power and energy put together, that's a large exposure. We think this was a sector which was also in a beaten down territory, neglected zone, and obviously we all know what sort of gaps are there in terms of power needs are there, which is well understood. This is area. Look at the NTPCs of the world. I'm just giving you, generally we don't talk about names. An example, nobody wants to willing to touch government company, okay, biggest contributor in this industry. Nobody will talk about, and then you look at how Power Grid, NTPC and all power companies has actually rallied significantly. We think they have still not peaked out. Yes, easy phase is over there also. If you expect that easy phase is there, they can double or triple even from the current level, then answer is no. But can they outperform the market? Answer is yes.
What can double from the current level?
I think individual names in pharmaceutical sectors, some of the banks, PSU banks still have more potential. Smaller PSU banks, okay, where numbers are still changing, okay, all these NPA related things which was also this everything, in fact, write backs will come in a big way. And they're still under-owned. People don't look at the mindset, okay, I deal with in my previous avatar as a banker and broker, we have dealt. A lot of people have mindset not to touch PSUs. Today, people are forced to participate, okay, it's not like with their interest they are buying because of price movement is so furious and you have a pressure of underperformance, so you are forcefully buying, you are not liking it, okay. There will be, I think that phase is yet to come where people will be sucked in this space, okay.
You're not there yet.
No, we are
you
not
will
there.
not look at selling your, you will not look at booking your profits in PSUs then?
See, on a rotation basis, we do stock a specific thing, but as a larger thesis, I think PSU has more legs.
Okay. Across the fund, mid cap, dynamic, equity diversified, there is one stock which is your top holding, Reliance.
Yeah.
Reliance is part in your large cap, small cap, asset allocation, dynamic. Why is that? Why have you taken such a large bet in all the funds that it is your top holding?
Okay, so again, Nikunj, is a conviction, okay.
If it has nothing to do with benchmark, right?
It's nothing to do with the benchmark. It has nothing to do. We don't, as I say, we don't follow benchmark, okay. Benchmark is only for our relative return performance is a benchmark which is given by regulators, so we have to keep in mind, but we don't hug bench. As active money, we are not passive fund house, neither we are passive fund house, nor we run our product in a quasi-passive manner in any sense. So if you look at the Reliance Industries, when you talk about, it's a showcase the data points which we have, the conviction we have. 1.5 years back, something similar situation we had in ITC also. It was ITC was the topmost holding 9-10%, 8-9% across all the funds we used to have. We exited, we made good money in ITC, bought at 202 or 208 levels. And 474, 500 levels, we exited that counter. It's not that we turned negative on ITC. It's about relative opportunity. So in market, we look at absolute and relative both. We felt easy phases over in ITC and another liquid names like Reliance was available, which has more potential than ITC for me.
How would you value Reliance?
So I don't look at, just I say purely from the valuation, I look at 1/3 only. We look at the risk appetite and liquidity. So liquidity analytics is very important for us. The risk appetite for Reliance Industries is rising. In fact, if I have to say, maybe this year belongs to Reliance as a group, okay? Generally, we don't comment, but if I look at all the stocks in individual basis, I think that's the one theme which is coming very out. Now, you want to give extraordinary weightage on energy separately, extraordinary for EV company, green energy. Reliance has very large component. The valuation is, nobody even count. Talk about telecom or AI related stuff, okay? Nobody wants to talk about. So they have all the spaces, you leave the O2C for time being, okay? Otherwise, they have all potential area where valuation, the markets are very rich. But as a collective, we don't want to give to Reliance Industry.
So I think also own Jio Financials as per your declared portfolio.
Yes.
So you're taking a bet on both the group companies.
So Jio, we have taken a bet because it is our largely a strategic thesis, okay? As we are turning negative on banks, okay? I think digital is the area which will be the way forward, okay? Bank in this avatar, if I have to put, will not generate alpha for us. In this avatar, they will not survive also, okay?
All right, there you have it. Lots of key takeaways, be it on valuations, the overall market trade setup, as well as what the view is when it comes to large banks. Exited ICICI Bank and HDFC Bank last year, and the preference for Sandeep Tandon is tilting towards some of the smaller banks. Media is a theme that will do well, ditto for mining.